Enough. Good afternoon. I'm glad that everyone has joined. I want to thank, first of all, Heather Ball, who has tried her best to make this work technologically. I want to thank everyone who has agreed to sign in for this day. And of course, I want to thank Dean Marecki for inviting me to talk about specifically the income tax responses to the COVID-19 pandemic. As you might expect, any major public crisis has its tax consequences, and this one is certainly no exception. What I'm going to be focusing on is the legislation called the CARES Act that was enacted on March 27th of this year. And while the great bulk of its provisions obviously are not related to tax, it of course has a number of tax provisions as well. Many of these provisions are intended to take effect immediately, and for the most part are only applicable to the current year, reflecting the fact that this is a sort of relief act. Having said that, it is particularly appropriate that we are talking about the subject today, because although this is July, this is actually tax day. I have to give credit to Dean Marecki for coming up with that timing. But the fact remains is that while this may not seem like April 15th, particularly if you go outside, this is the equivalent of April 15th for most tax years. Namely, this is the day that tax returns are due. People can, of course, file extensions as they always have, but this is the typical day when they would be flooding the mailboxes, or the proverbial mailboxes, the virtual mailboxes, and that therefore this is an especially appropriate time to talk about the tax provisions. I should also indicate at the outset how I'm going to do this is sort of as follows. I'm going to focus on those provisions that apply to individual taxpayers primarily, because once one gets into some of the business tax provisions, it gets very much into the weeds, and the objective of this provision, of this session rather, was to focus really more on provisions that might be of interest to general practitioners. So for people who are really looking for the deep dive, they may want to access some other kinds of programs. In addition, how this is going to be organized is around, you could say, 4 basic topics. The first 3 relate very much to individuals and to self-run businesses, proprietorships. They respond to recovery rebates, certain loss limitations, and then charitable contributions. Then the second component, if you will, of this session, the 4th major subject will be retirement plans. Having said that, because each of these subjects is so discrete and so separate from the others, I thought I would take questions along the way, and I will specifically pause at the end of any particular subject rather than going on, because there's not going to be any sort of burning bush at the end, or really any type of explanation of how this material ties together. These are all, you could say, a laundry list. The expression used to be a Christmas tree, typically because this would be enacted in December, but it's a whole set of provisions that don't, for the most part, have a lot of interconnection. So with that, let's go ahead and begin. And the first main subject is the so-called recovery rebates. Recovery rebates is the technical term for what most people are anticipating, namely the $1,200 check that they're receiving. The official term, and it's not just because this is tax geek kind of talk, is that these are recovery rebates. They're supposed to be tied to the economic recovery, and they are actually rebates in advance or credits on people's 2020 tax returns. So this is where it gets, shall we say, somewhat bizarre, that people are getting the money now based on income of 2020, which they of course do not know, and therefore for computation purposes, the government is using the people's 2019 tax return. As I indicated at the front end, many of those tax returns, however, are being filed today. And so for people who have not filed a 2019 tax return, they are using the 2018 tax return. The payments actually should have been received by now. So there have been some delays. It's a government program after all, and they're starting from scratch. But for most part, the payments are $1,200 per person, plus an additional $500 per qualifying child. And that gets into some other definitions that have been in the law for some time, are not really new here. But this is supposed to be $1,200 per person. If it's a single person, that's the end of the story. Married people, it would be $2,400. And then qualifying child, typically under 17, there would be $500. They should have been received by now, usually not in the form of a paper check, but rather if people have filed electronically, whether doing a tax return or filing some other sort of filing to the IRS, the payment should have been made as a direct deposit. Some 95% of US taxpayers file electronically, so the people getting checks are primarily people who have not filed a return at all, or in that 5%. The amount that of the 1,200 could have been reduced, and many people on this call, I presume, have received nothing, but many of their relatives and friends may have. That is, the amount would have been reduced depending on their taxable income. So this is the final number after itemized deductions and the rest. Based on their 2019 tax return, if they had filed it by this point, or if not on their 2018 tax return. And so there is a phase out range, as is typical of these kinds of provisions. The phase out range begins for single people at 75,000, for married folk at 150,000. So it's a 2-to-1 ratio, and therefore there is no marriage tax penalty. And then for people who are heads of household, it's a number right in between 112,500. How the phase out works is that any income above those thresholds, 75,000 for singles, 112,500 for heads of household, 150,000 for marrieds, 5% of the taxable income from this prior year is taken as a reduction. And so people would have received less than $1,200 if their income was above those particular thresholds. And then the numbers that are on the screen here, these are the numbers where the recovery rebate was completely phased out. So if people had 99,000, for example, as singles, or 146,500 for heads of households, or 198,000 for joint tax returns, they would not have received anything thus far. It's not because the IRS is late, it's because for them, the recovery rebate has been completely phased out and they are not going to be receiving one. All of this is sort of based on, again, their 2019 tax return, if it had been filed by the time the IRS was crunching through these rebates, and if not, their 2018 tax return. And there has been a fair amount of press about how some deceased taxpayers have received these recovery rebates. After all, the test is not whether they are alive today, the test is whether they were alive and filed a tax return in these prior years, 2019 or possibly 2018. So dead people getting these rebates is not really unanticipated. At the same time, the number sounds kind of big, over 1.4 million deceased taxpayers, but as a percentage of total payments received, it's really pretty small. Nevertheless, there is a controversy, shall we say, whether the taxpayers or their representatives are obligated to repay those amounts. The Treasury Secretary, Mnuchin, has said that yes, they should. That is still sort of in the air. In 2008, there was a similar kind of program, and ultimately it was decided that people who had deceased and had received those rebates did not have to. So the official position of the IRS right now is yes, they must return it. There is authority for them not needing to do so, and at least in 2008, the most recent precedent, they did not. Beyond that, there's sort of two interesting points. The first is, what if, since all of this is based on 2019 or possibly 2018, but it does relate to taxable year 2020, which we're barely halfway through. What happens if the income in 2020 is actually lower than it was in 2019, to the point that since this is an advance tax credit on the tax liability for 2020, these people would have received a smaller amount in this recovery rebate than they really are entitled to. And the short answer is that when they file their 2020 tax return, it will in fact be based on their taxable income for 2020. And since the amount that they are entitled to is less than what they received already, they will get an increased tax credit. This may get somewhat buried, if you will, in the sort of the black box that is tax return preparation, but they should receive an increased tax credit, and it will be presumably shown on the tax return, though most people tend to focus on their ultimate liability. The fact is that liability will be less than what it would have been. So I was dealing with a friend's student who had a very good year this year due to a lot of overtime. That is not the current year, but 2019, and had a lot of overtime. But in 2020, they started a graduate school program. They are not going to be able to do that, and so their taxable income in 2020 will be significantly lower. And while the rebate that they already received had been reduced because of this phase out, they will get a restored 2020 tax credit when they do their 2020 tax return, but that won't be visible until literally next March or April. So there will be a reconciliation, if you want to think of it that way, for people whose taxable income in 2020 turns out to be lower than the 2019 or 2018 figure on which the recovery rebate was calculated. And going in the other direction, if people have higher income in 2020, if we were being symmetrical or consistent, we would say that they need to repay the credit that they received earlier this year, to which they are really not entitled. But that's not how Congress set it up. And so this is a kind of the heads taxpayer wins, tails government loses. So going back to the prior point, if people have lower income this year, they will get an augmented tax credit higher than what they had received before. But in the reverse situation, where their income goes up this year, they don't have to worry about it. They will not have to repay anything. They won't get any additional tax credit, but at least they're not having to sort of cough up the difference, if it were. So that's basically the recovery rebates. Sort of the main takeaways is that those who are entitled to this and are not phased out should have already received it. The phased out numbers are shown on the screen in the first bullet: 99,000 for singles, twice that for joint filers, the midpoint for heads of households. There will be a reconciliation at the end of the year. If people's income in 2020 is less, then they will get a sort of unexpected benefit. If their income is higher, no harm, no foul. That is the recovery rebates. Let me take a pause here before we move on to another subject because there's really not going to be much interaction with any subsequent subjects and the recovery rebate. So I'm not seeing hands, but that's because my screen is somewhat truncated. Let me just pause. Any people have any questions, comments, complaints? Well, you're certainly welcome to bring something up later, but Heather, is there anything in the queue?
There is not.
All right, very good. People should feel free to unmute themselves if they do. If we have a real stampede, then we'll try to create some sort of order. But in any case, let's move on. So the next general subject is a business type subject, but this is especially pertinent for proprietorships and other business entities. It's not an exclusively corporate kind of provision. And there are basically two limits here, a limit on business interest and a limit on losses. I'm going to take them one at a time, and both of these provisions have several elements in common. One, these are relief provisions, mainly for the current year, typically also for a prior year. Secondly, the loss limitations that we're talking about are not provisions that people may be familiar with because they've always been in the law. That's not the case. Both of these were introduced in 2017 as part of the Tax Cuts and Jobs Act. This is the big Trump Tax Cut Act. And in order to get close to their budget figure, that is to not have more of a deficit hit than was expected, many of the provisions had to be balanced by some reductions of tax benefits on the business side, and that's where these two provisions came in. So the first one is a limitation on business interest expense. Prior to 2017, as long as the interest expense pertained to business, trade or business operations, there was never a cap. Even if you ended up with a net operating loss, it would be carried forward, possibly back, but there was no artificial limit, and that was an innovation, if you will, of 2017 that said no more than 30% of earnings before interest, taxes, depreciation, and amortization could be offset by business interest expense. Now, the rest was not lost. It was simply carried forward, but this was for the first time a company, a proprietorship could not basically zero out their tax liability through interest expense. EBITDA, that's the acronym for earnings before interest, taxes, and depreciation and amortization. There was this artificial limit of 30%. That limit is made somewhat less severe. It is for last year tax returns that are being currently filed, and for the current taxable year, the limitation still exists, but it is being increased to 50%. That's why I put that number in bold, to 50% of EBITDA rather than 30% of EBITDA. So prior to 2017, there was never a business interest expense that was this widely applied. There was a so-called disqualified interest under 163J, but that was a relatively minor or focused limitation. This applies to the great swath of American businesses. They did not get rid of the business interest expense limitation, but they loosened it for last year and this year by increasing the threshold limitation from 30% to 50%. The other limitation does apply exclusively to corporations, and this again is in the nature of trying to provide some liquidity to the economy, and more specifically to provide a rebate of prior year's taxes. Again, reflecting not only the pandemic, but the business shutdown, which happened more or less simultaneously, but of course they don't necessarily have to be correlated. That is, the pandemic could happen and there would not necessarily have been a shutdown, but because there was, and the concern of the government was to limit the number of companies that were going to be basically thrown into bankruptcy, the idea was to provide them as much liquidity as could be done. And one way, rather than having the distribution of checks, which first of all takes time, and secondly has a certain amount of political, shall we say, sensitivity, what it said was that if the company, typically the corporation here, had taxable income in prior years, then they could recover the taxes they paid. So the corporate NOLs in 2017 were changed to have a longer carry forward period, but no carry back period. So that was a big change. And instead, what's happened in the CARES Act, two things. One, they can be carried back. First of all, that's a reversal of 2017. And not only that, they can be carried back for 5 years. So if the company made any profits in the prior 5 years and paid taxes, then they can get a refund of those. Secondly, one of, again, the kind of unprecedented change in 2017 was that if a person, a company rather, had a corporate NOL, a net operating loss, in the past they had always been able to use it against their entire taxable income. But as part of the 2017 Tax Act that said we don't want companies to basically zero out their tax liability, they said you can't use it against more than 80% of the year's taxable income. That cap, that 80%, has been eliminated. It now can be used against the entire taxable income. You can see why people are feeling a little bit whipsawed here or getting a little sense of nausea because now we're going back not only to pre-2017 law, namely use it against all of the taxable income without limitation, but also restore the idea of a carryback, but then augment that so that the carryback is 5 years rather than the preceding 2, or depending on how old one wants to be, admit to it's 3 years. So this is a combination of making the 2017 provision less severe and actually reducing its impact almost entirely. This is effective for tax losses achieved in 2018, 2019, and of course during this pandemic year. Many companies, some companies were losing money in 2018 and 2019, but that of course had nothing to do with the coronavirus. But they were trying to make this as generous as possible on the idea that even if they didn't have losses in those prior years, if they did, even more of a reason to get them some liquidity. There's a similar provision that I'm not going to go into here, but therefore disallowance of business losses for non-corporations that were in excess of $250,000 for singles and $500,000 for joint filers. If this is of interest, people may want to consult their expert, their regular tax advisor. That also was suspended for 2018 and 2020, but that's basically the limits on business interest and losses. Again, the main takeaways, the limits were loosened, if not completely eliminated, and in some cases, such as the corporate NOL, actually made sweeter than it has been in quite some time. Let me pause here and see if there are any questions before we move to a completely unrelated topic.
I don't have anything so
Good
far.
enough. Thank you, Heather. I do appreciate it. We'll move on now to a different topic entirely, which has received a little bit of publicity, as going to receive lots more. And it's one of those things where lawyers in general and tax lawyers in particular are going to be in the not especially comfortable position of trying to tamp down some enthusiasm, curb your enthusiasm, as the expression goes, because there are two main liberalizations of the charitable contribution deduction, but at least in the first case, there's less here than meets the eye. But here's the first one. There is a brand new above the line deduction for charitable contributions for taxpayers who do not itemize their deductions generally. So this is not completely unprecedented, and I'm not going to get into ancient history, but there was a similar above the line deduction. Part of the idea here is that people are suffering. At the same time, some people are not. And so as we're seeing all these various sad stories, which are genuinely sad, if not heartbreaking, there's a charitable impulse. And the thought is we ought to encourage people to make charitable contributions this year, perhaps more than most. But the fact of the matter is that one of the 2017 Tax Act's provisions made taking charitable contributions as a deduction much less common. This wasn't exactly a specific goal, but it was the inevitable consequence of almost doubling the standard deduction. And so if the standard deduction is doubled, we would expect fewer people to itemize their deductions because they would now be able to claim a larger amount. And sure enough, that has happened. Now, to put this in perspective, even before that change, only about 30% to 32% of taxpayers in any given year itemize their deductions. Nevertheless, as a result of the 2017 Tax Act, the percentage of taxpayers who were itemizing their deductions fell to around 10%. So from 32 to 10%, that's about a 2/3 reduction of the people who could claim charitable contributions on their tax return. In response to that change, they of course didn't touch the standard deduction, which was increased, which was the sort of the genesis or the cause of this issue. But what they did was create a special, for this year only, above the line deduction. Now, this is not in addition to deductions claimed for people who itemize. This is instead of. And so specifically, as the last line indicates, this is for people who do not itemize. So if people have large mortgage interest and the $10,000 of state and local taxes and have charitable contributions, if they were itemizing before, they're going to be itemizing now. But if they are among the people who did not itemize previously, or even those who had up until the 2017 change, then this may be of interest to them. I say may because there are three key limitations. The first is this is only for payments made in cash or credit card or check. But I mean, this is not for donations of property. So people who give property to, use property to Goodwill, for example, or Salvation Army. A lot of people are using some of this stay in place time to clean up their closets. That is a good idea, but those kinds of contributions do not qualify for this special deduction. Secondly, the most that anyone can deduct is $300. Now, at this point, a lot of people are going to be looking at their smartphones because they sort of, hey, this is not terribly of interest. And remember, this is a deduction. So even if they're in the 35% tax bracket, which is pretty high, it's not the highest, then this is a reduction of their taxes by only $105. And most people who are in that high tax bracket are going to be itemizing anyway. So the people for whom this would be a benefit are people in lower tax brackets, more like 24%. So this would be a maximum benefit of about $72. In any case, this is for this year only. Of course, everything possibly could be extended, but probably is not going to be. This was, hopefully the pandemic will start to ameliorate, but for this year, this is a special one-time only deduction for the great bulk of taxpayers, around 90%, who don't itemize their deductions. This is if they give money in church, the usual donees apply in church, or to the University of Illinois Law School, just got to get that plug in, or of course to other organizations, public radio and the like, then they can contribute up to $300. And one of the interesting, not sure I'd call it an ethical conundrum, is whether people who don't make the contributions are going to deduct it anyway. I saw one article in a tax journal that referred to this provision, quote, as functionally not auditable. That is, with a maximum deduction of $300, how much resources is the IRS going to devote? The fact of the matter is they could audit these people. There's always that risk. But the fact of the matter is it's only for this year a maximum of $300. Keep in mind that if people are, this is for people 70 and a half, and particularly if they are doing qualified charitable distributions, usually that's still going to be a more advantageous strategy. I'll comment on that a little bit more when we get to retirement plan distributions, but this is a provision that I think is going to get a fair amount of publicity, especially in December, when the various organizations through Giving Tuesday and the like are going to try to make a pitch to people who have historically not been able to get a tax benefit from claiming charitable deductions this year, and this year only, as far as we know, they will be able to. The other change, I said there were two major changes, is much bigger, but again, not entirely huge in terms of how many people it's going to affect. And that is, there has always been a limit of how much people could deduct. And here we're talking about the 10% of Americans who are claiming itemized deductions. There has always been a limit as to how much the charitable contribution could be. Some people may remember in class when we covered this, we were kind of curious as to why there should be a limit on how charitable one can be, but suffice it to say, it's typically been 50% of the person's adjusted gross income. It was recently augmented to 60%, that is up from 50. Not a big change, and the fact of the matter is most people don't give anywhere close to this. But nevertheless, the change that was made in the CARES Act was saying this year and this year only, you can literally use charitable contributions to wipe out your tax liability. That is, for this year and this year only, and this is brand new and has never been the case, the people can deduct actually all of their charitable contributions, even up to and including the amount of their adjustable gross income. They can literally wipe it out. Again, for the most part, people's charitable contributions are much less than even the 50% limit, let alone the 60, let alone the 100. But for what it's worth in terms of a general nuisance, this particular limitation has been called off for this year. There is a comparable increase for corporate charitable contributions, and I mentioned that in connection. We've seen a lot of corporations during this recent response to the George Floyd episode give donations to various organizations, and there's been historically a limit as to how much corporations could deduct, usually 10% of their taxable income. They don't have AGI. That has also been augmented to 25%, again for taxable years beginning in 2020. So let me pause here and see if there are any questions, because then we're going to spend the rest of today on retirement plans. Anyone in the queue?
I don't see anything. Oh, wait, there's someone.
Professor Kaplan, on this charitable contribution deduction, does it apply to all, you do it to your own personal foundations?
That's a great point. You're talking about the limit?
Yes.
Yeah, I need to look at that. I believe the answer is no, because, I'm sorry? Oh, getting some feedback here. But in any case, the limit that they increased was the one for so-called public charities. That was the one that was previously 50%, then made into 60, then made now into 100%. That's the only limitation that they've changed. As the participant quite correctly implies, there are other limits, including for so-called private foundations and also for private use organizations. Those have had limits of 20% and 30%. Those were not changed before, they're not changed now. This is only for the so-called public charity limit. That's the 50% historically. The 20 and 30% were left untouched, but a very good question. All right, so moving on to retirement plans. Retirement plans, this has gotten some publicity. There are actually three separate provisions here. One relating to withdrawals, two relating to loans, and three relating to distributions. So I'm going to take those up one at a time. I would say that if you wanted to lay this out in terms of age, that the first two are for people of any age, particularly younger, namely under 70. And then the last one is of interest to people who are over age 70 and a half. But anyway, retirement plan distributions. This is of particular concern to people who are under age 59 and a half. The reason for that is that people under age 59 and a half who take out a withdrawal from a retirement plan, and this is 401ks, IRAs, 457s, 403b, the whole silly menagerie of these plans, they have been subject to a 10% penalty for early withdrawal, meaning prior to age 59 and a half. Now, if they're over 59 and a half, there was no early withdrawal penalty before, and so this provision is irrelevant. That is, they weren't subject to the penalty before, they still aren't. But for people who are under age 59 and a half, they were historically subject to a penalty of 10% of the withdrawal, in addition, of course, to having to pay tax on that. And though this provision, that particular provision has really not been made as clear. They're saying, penalty free, and it is penalty free. But when people take the money out of the withdrawal of the retirement plan, they're still having to include it in their taxable income. And so they'll still pay federal income tax. Now in Illinois, we don't tax retirement plan distributions, but in other states that do tax retirement plan distributions, then there will be state income tax as well. But for certain, there will be federal income tax plans, federal income tax consequences. And so, yes, they don't have to pay the 10% penalty, but they're still going to be paying income tax on that. Now, this is allowed up to 100,000. The criteria here is for the last phrase on the screen, for persons directly affected by COVID-19, which is the disease that's caused by the coronavirus. What they mean by directly affected, well, either the person, the taxpayer, the owner of the retirement plan, or their spouse, or their dependent has been diagnosed with COVID-19, and typically that would be documented by taking a test. Now, depending on where you live, it may be difficult to get a test, or there may be a delay, but that's still the principal way of determining that you've been diagnosed with COVID-19, either the account holder or their spouse or a dependent. If that has not been the case, then they can still qualify if any of these three people have suffered adverse financial or employment consequences due to COVID-19. So this recognizes that a person could have economic consequences of COVID-19 even without having been diagnosed by COVID-19. And so this would be all sorts of things, such as you can't work because you no longer have childcare, or business hours have been lost because the company is reducing hours for everybody. So these are economic consequences, financial consequences that are independent of whether the person has COVID-19. In addition, this is what the statute provides. About 3 weeks ago, specifically on June 23rd, the IRS issued a notice. That's notice 2020-50. That's notice 2020-50 that elaborated on these economic or financial or employment consequences and said, for example, if an offer has been rescinded, that would qualify as well. And one that I was thinking of that is mentioned in this notice of particular interest to some recent graduates is that delayed starting date. Some law firms have simply said, don't come here after the bar exam, wait till September or October 1. That again is a delayed start date. That's a financial consequence that will qualify or enable the person to make this penalty-free withdrawal. In this instance, actually in both circumstances, that is the diagnosis or the suffering of financial and employment consequences, the self-certification to the employer is sufficient. Now, some employers may want to see the test to protect themselves, and if the IRS were to come and audit, the actual COVID-19 test would still be the best evidence, but at least for purposes of making a withdrawal, the account holder simply has to indicate that they have been diagnosed with COVID-19 or have suffered these various business consequences. Again, loss of childcare, reduction of hours, delayed start date, rescinded offers, that sort of thing. But at least the self-certification is sufficient. Now, as I indicated, the amount is penalty free, but you still have to report it in income. Now, here's where another beneficial provision applies, and that is in virtually every case that we've had up till now, if you take the money out of the retirement plan, A, there's going to be a 10% penalty for people under 59 and a half, and B, you have to report it in income in the current year. As we indicated, the penalty is being suspended if the person qualifies here. A secondary benefit is, yes, the amount is taxable, but it can be spread over 3 years so that the amount reduces the tax, that is because of the various graduated brackets. The default provision is that the withdrawal is divided by 3, and that amount is included in 2020, 2021, and 2022. There is a provision that says the taxpayer can elect otherwise, but they mean earlier reporting. So, for example, if a person wanted to report more or possibly even all of it this year, they may conclude that they are going to be in a lower tax bracket this year, or they're being called back to work. This election can be made much later. If they get called back to work or have their hours restored in November or December, then they will say, well, I don't really need more income to be reported in that year, so I will report it 80% this year, 20% next year, or 100% this year. So the taxpayer has the ability to accelerate the reporting, but otherwise it'll be spread over 3 years. This is a feature that has never been accorded to taxpayers who withdraw money from a retirement plan. In fact, to make this even more appealing, there is a further provision that says if the taxpayer changes his or her mind, that person can put the money back during that 3-year period, and this will not count against however much they can put in any given year. So again, for people who are needing the money to live on and figure, look, retirement is mañana, and you need to get through the current crisis, this is an incentive to take the money out. This may, if they do get a lot of second looks, they can spread the income over 3 years in terms of reporting it. They can also simply recontribute it to any plan and therefore avoid taxation. So let me just emphasize that. The amounts can be recontributed during this 3-year period to any retirement plan. So it need not be put back into this particular employer's 401k. It could be put into, say, an IRA or some other kind of retirement plan. So this is, again, additional flexibility. They can be, first of all, recontributed. Secondly, during any time during the three-year period, and to any retirement plan, not just the retirement plan from which it was withdrawn. And again, this is the so-called blue plate special. That is for Kmart shoppers. This is just for this year. And I'm not sure if this is a drafting peculiarity, but what I put on the bottom of the slide is literally what the statute says, namely for withdrawals made before December 31st. And so that would mean through December 30th. This may be fixed with a technical corrections act, who knows, but so far there's been no movement. So I would suggest as a matter of precaution, don't wait till the very last day of the year. It needs to be done before December 31st. Now, this is, you could say, the range of options. I'm not going to imply that this is necessarily a good idea. From an analytical standpoint, it clearly prioritizes present needs over the future. The taxpayer is still going to be losing out on investment returns that they would receive during that 3-year period. And secondarily, not so much in Illinois, but in some states, this exposes the retirement plan assets to creditors because now they're going to be not within the umbrella of the retirement plan. But in any case, for those who want this option, that is available. In the interest of time, let me go ahead and I'll take questions sort of at the end about all these retirement plan provisions. The second major category are loans. We can save some time here. Eligibility to take these loans is the exact same eligibility as for the withdrawal. So the same business about that the person has been diagnosed with COVID or has suffered adverse financial or economic consequences, exact same eligibility. Here, the change is that the maximum loan amount, which previously was $50,000, has been increased to $100,000, but of course still limited to the amount that the person has in the account. That would seem to be almost taken for granted, but the amount that is the maximum loan is $100,000 up to the present value of their so-called non-forfeitable accrued benefit. So they can't take out more than what they've got in the plan, but they can take out up to $100,000 of what they have in the plan. There's a further benefit. Typically, retirement plan loans are due within 5 years, where there is a 1-year grace period for this year. And so not just for new loans, but this is also for pre-existing loans or loans that were taken out in prior year. So it says that for calendar year 2020, you're allowed to make a repayment, of course, but if you don't want to, that's okay. And what it means is that if the loan payment or it matures this year, just extend it for 1 year. This retirement plan loans, I should point out, are not available for IRAs. They're only employer-sponsored plans, whether they are 401k, 403B, 457, and the like. That's always been the case. Can't take out a loan from an IRA, but for employment-related employer-sponsored plans, then at least this is a further option. The benefit of a loan, of course, is that this is not included in taxable income, even over 3 years, because you have the obligation to repay. But on the other hand, there is the obligation to repay. So this is another quiver in the person's panoply of possible options to provide some financial relief. And then the final part here, which is actually a combination of the CARES Act of March 27th of this year and the so-called Secure Act, which was enacted at the very end of 2019. And some people may have missed some of it, but they're sort of working in tandem. First of all, they did a waiver of required minimum distributions for this year. So at this point, we're now talking about people who are older, at least over age 70. That is, the retirement plan withdrawals was really aimed at people under age 59 and a half in terms of the no penalty. The retirement plan loans was aimed really at anybody, but particularly people under age 70. And this provision, this slide is about for people age 70 and a half at least. This applies to 401k plans as well as IRAs. And I was dealing with a friend on this issue. This also applies to inherited IRAs. So as many people know, if a person inherits an IRA, not a spouse. Spouses have other options. Surviving spouses have other options that they can keep it as their own account and so forth. But an inherited IRA also has required minimum distributions, regardless of how old the heir is, the beneficiary. But the point is that for distributions that would be required during calendar year 2020, the short answer is they don't have to do it. And for people who made distributions prior to when this was all announced, March 27th, they can actually put the money back. This was, again, this is another IRS notice. This one is 2020-51, again, released on June 23rd. And there was, they said it doesn't have to be within 60 days. It just needs to be by August 31st. Now, what this might do, and some of the charities are worried about this, is that people who are above this age have historically have been allowed to do straight transfers to qualifying charitable donees, and these so-called qualified charitable distributions might not appeal. They literally don't have to do one this year because the requirement for required minimum distributions has been suspended. Now, some people may want to do it anyway, but the point is that if people have not already taken the so-called RMD this year, they don't have to. And for people who already did so, then they can put the money back. When I was talking about the age, this is the Secure Act of December 20th, 2019. There's a critical date here. And so this is based on the birth date. For people who were born June 30th, before June 30th of 1949, nothing has changed. That is, the age at which minimum required distributions must begin, the so-called required beginning date, is still 70 and a half. That is not changed. But for people who were born from July 1, 1949 and later, their required beginning age is now age 72. So that's the first change in about 30 plus years. But in any case, for this calendar year, no one has to make a required minimum distribution. While I'm on this point about the Secure Act, this is a kind of, particularly for estate planners or for people who have retirement plans, that is a correlative change made in the Secure Act is extremely important, and that is other than spousal beneficiaries. That is, if a plan goes to a sister or brother or to their children or grandchildren, historically, those non-spouse beneficiaries have been required to take out the amount over their own life expectancy, which could be up to 70 years or so. That has now been changed so to be 10 years following the death of the plan owner. That applies, by the way, to Roth accounts. Roth accounts, people may remember, are not taxable, even in the hands of an inherited Roth account, but they still have to take the required minimum distributions, and those also must be done over a 10-year period. It's not going to change the taxability of those amounts because they're not taxable, but what it means is they're going to lose some of the tax-free accumulation they would otherwise have done. A kind of fine point that I'll close on, and then we'll take some questions as much as I'm willing to stay here as long as people want to talk. But the fine point is that the distribution period is changed to 10 years, but more technically, the account has to be drained by the end of the 10th year. So if this is a taxable account, that's probably going to mean take distributions over the 10 years so you don't have some ginormous amount in that 10th year. But if this is a Roth account that the person inherited, they might well want to just leave it accumulate and take it all out at the end of the 10th year. Yes, that'll be a big distribution, but it's not taxable anyway. And this way you prolong the possibility of tax-free accumulation. Again, I thank everyone for participating and tuning in. Thank Heather Ball for emceeing this, and I will